session. So this particular session is a follow-up from my first session. So obviously, I tried building it up in the first one and covered more or less. Of course, it's very difficult to cover everything, but I tried as much as covering all the bases. So, and this one is purely questions and answers, right? If it makes sense, right? In a minute or two, I will share the questions I've received, which were basically following up from my earlier session. So please bear with me if you think that you didn't join the first one and suddenly I'm answering questions and you're feeling awkward. In that case, my polite request will be to get in touch with Vivek and request him for sharing the link, which he has kindly put into LinkedIn, YouTube, the full recorded version of my first session, right? And even if there is any further questions, you can always go back to Vivek or invite me for other things like inheritance tax planning or investment planning, or contact me directly. So there are other ways and means. I was reading very quickly through the chat. Vivek, there are already a few more questions. Unfortunately, I won't be able to cover because I got lots. So what I did, I collated them and segmented them so that when I'm discussing them, I'm not discussing random things. I'm discussing in a flow, covering, say, for example, lifetime allowance, covering annual allowance questions, covering scheme pay questions, covering early retirement reduction buyout questions. So everything separately, so that when I'm discussing a particular topic, I'm trying to answer all the questions related to that particular topic, right? So that's why I segmented them. So without further delay, with your permission, I will request Vivek. Can I share the screen now?
Yes, please.
Yeah, thank you very much. So there were loads of questions. I shortlisted them and took out the questions were repeats, basically verbatims. So, and that boiled it down to 60 questions. So I will go and answer to all the questions I've got collated over here. So first of all, very quickly, somebody asked me, where am I based? Right? I'm based in, I live in Batley, which is a border town between Morley and Wakefield, right? The area I live in is Dewsbury, Leeds, Wakefield, Birstall, Morley sort of area. My office is in Leeds, right? But in this world, technically and technologically connected, right? I do look after investors throughout the nation, right? So anyway, that's where am I based? And right, this is a very interesting question. Somebody asked me that, can speakers introduce themselves with affiliation and conflict of interest and blah, blah. So yeah, why not answer it? So this was on no obligation basis. So there is an expectation. You guys invited me, and I'm doing the sessions, right? So if you feel a requirement, or if you are interested in knowing more, you can always contact me. You don't have to. So there is no as such set interest on at the back of this these sessions, right? So moving on to the first question, and this is type A, coming under all questions I have tried, right? There may be some exceptions when I was not careful, but more or less I've tried putting all the questions related to annual allowance charge and scheme pay related questions in this segment. So first one says that if somebody changes their PA, or they're going from part-time to full-time and so on and so forth, is their annual allowance charge going to be different or not? Yes and no. Yes. Why? Though while calculating your pensionable earning, they take your whole time equivalent total earning, whole time total earnings. But if you're working only 50% of the time, then obviously for 1 year, actually it's half a year. So instead of the full year's growth, you'll get only half a year's growth on the full pay. So though it's based on whole time equivalent pay, but if you're working only half the PA, or 5 instead of 10, or 8 instead of 10, in that case 80%, so your pension will grow by 80%. So, and that will reflect in your growth in the pension pot, because if you can remember, I did share one example annual allowance statement that you receive not by default, but only when this is triggered. That means in a particular tax year, your total growth in the pension pot goes over 40%. then you get a statement from SPPA or NHS that in that particular year, your annual allowance has been, or sorry, your pension growth has been more than your standard annual allowance. But mind that SPPA or NHS doesn't know, first of all, whether you got carried forward annual allowances or not from the last 3 years. Secondly, they also don't know whether your annual allowance has been standard or tapered. I'm assuming that you know what is tapering. That means if your adjusted earning until 2019-20 had been more than 150,000, and in this current year, the limits have been raised. In this particular 2021, the standard annual allowance is tapered if your adjusted earning is over 240,000 and your threshold earning is over 200,000. So that's the criteria in 2021, but until 2019-20, if your threshold earning or your net taxable earning was more than 110,000, then they would have looked into your total adjusted earnings. And if your adjusted earnings were more than 150,000, then you were affected by the tapered annual allowance. Sorry, coming back to the answer that NHS or SPPA doesn't have any way of knowing whether your annual allowance has been standard or tapered. They don't know whether you got carry forward or not. They will only send you the letter if in a particular tax year in isolation, your growth in the pension pot, that means pension input amount or pension growth amount in the NHS scheme, both the NHS schemes put together, added up together, has gone above 40,000. Then only you'll receive the letter. Otherwise, you won't receive the letter. If you need to know, in that case, you'll have to write to your respective body. That means if you are in Scotland, you'll have to write to SPPA. If you are in England and Wales, you'll have to write to NHS. So then it says, how can we predict growth of pension that we can avoid charges? Very interesting question. Now, you can't. First of all, you can't. Because why you can't? Let me just explain. Your growth in the pension pot is calculated with the help of a formula. Just to remind you, it's basically the pot size, deemed pension pot size at the beginning of the tax year, and the deemed pension pot size at the end of the tax year. And the difference between the both is your pension growth. And when I say that it's the deemed pension pot size, whether it's beginning of the year or the end of the tax year, is calculated through a formula. And the formula is 16 times of your pension at the beginning of the tax year plus the full tax-free cash if it's 1995 scheme. Otherwise, it will be zero if it's a 2015 scheme. And then operated by the inflation. That's your pot size at the beginning of the tax year. And the end of the tax year pot size will be 16 times of your pension, projected pension, estimated pension at the end of the tax year, plus your tax-free cash lump sum eligibility. And if you got two schemes, you'll have to use the same formula and add both the amounts which you have calculated through the 1995 scheme as well as using the same formula, 16 times pension plus tax-free cash. Similarly, 16 times pension plus tax-free cash in case of 2015 scheme will be zero. You add them up, that's your pot size. You don't adjust it against inflation for the end of the tax year figure. And the difference between both, so I'm not requesting or expecting that you will have to remember the formula or anything. No, that's not the idea when I explain the formula. The idea is that it is based, or the thing I'm trying to establish is that is calculated through some formula. And when I'm calculating the formula, it's got to do with your pensionable earnings, because if I have to calculate your pension, I need to know your pensionable earning, the number of years you have been in the scheme, the type of scheme I'm considering, is it 1995 scheme or 2008 scheme or 2015 scheme? And that will help me or help NHS or SPPA to calculate your pension, projected pension, or whether you've got a tax-free cash lump sum by default or not through that scheme. And then inflation rate. England, for the month of September in a particular year, right? So there is nowhere the amount of contribution you're making or your employer is making. It's purely based on formula. And while sitting at the beginning of the tax year, there is absolutely no way of knowing what the month of September inflation rate is going to be. So you can't predict. You can estimate, assuming, right, that the inflation rate would be this much, or this much, but you can't. And also, you probably at the beginning of the tax year or at the middle of the tax year, there is absolutely no way of knowing how much your pensionable earning will be at the end of the tax year. So there are unknown factors. So there is no way of knowing that how much your end of the year tax year pension pot size will be, deemed pension pot size will be. So answer to that, sorry, a very long-winded and complicated answer, but the answer is no. There is no way of predicting. You can play around, you can put figures and extrapolate or find out different figures that what happens if my pensionable earning by the end of the tax year is this much or this much. Sensitivity, you can do that, but not exact amount. So you'll have to wait until the tax year has finished. And now only all the figures are known for sure. Number 6, can extra shifts during COVID? Yes, I have answered it last time, that if it's pensionable earning, it will impact any pensionable earning. So you need to know that which types of earnings, awards, or extra call, on-call earnings or extra hours or private practice are pensionable and which are not pensionable. And if it's pensionable, yes, it will let your pension pot grow at a higher rate. When does the annual allowance become tax problem? Simple. The moment you have gone above, or your pension growth amount has gone above 40,000 and you don't have any more carried forward annual allowances, or your growth in a particular tax year in the pot is more than your standard or tapered annual allowance in the tax year, plus all the unutilized carried forward annual allowances from the last 3 years. That's when you're a problem. And what is the problem? The problem is that, for example, your total growth is 55,000 and you're not affected by tapering. So 40,000 is your standard annual allowance and you had 10,000 pound carried forward from the last 3 years. So 50,000 is your total allowance available for the tax year and your growth is 55. So you are over by 5,000 pound. And if you are a Scottish 41% taxpayer, then you'll have to pay 41% of 5,000 pound as your annual allowance charge in that tax year. If you're in NHS, sorry, in UK and England and Wales, you're a 40% taxpayer, then 40% of 5,000. If you are a 45% taxpayer, then it will be 45% of 5,000 pound. Am I right in thinking that private pension growth is not taken into consideration to calculate annual allowance? Bingo. Yes. It's not the growth. It is growth for the NHS scheme or any type of final salary scheme. It's only the contribution you have made that's added on top of the pension growth of NHS to derive at the final amount of annual allowance for that tax year. So what you do, hypothetically, you have contributed 10,000 pound in a private pension or a SIP in a particular tax year, and your NHS pension grew by 35,000. Assuming you don't have any carried forward annual allowances and you're not affected by tapering, your standard annual allowance is 40 and your 35,000 is a growth in the NHS pension pot between the two schemes and another 10,000 put into a private pension. So your total contribution plus growth would be 35 plus 10, 45. Your standard annual allowance is 40. So 5,000 over and above. So you'll have to pay annual allowance charge at your highest marginal tax rate, income tax rate, on that 5,000 pound, if it makes sense. So it's not the growth in a particular year. And next year, you didn't contribute anything. And that 10 has become 12. That 2,000 won't be considered because for private pension, it's not a growth. Calculate. Sorry, somebody started typing a question but never finished it. I'm assuming how to calculate annual allowance. So how could I do the calculations? It's a similar question, number 10 as well. How do I do the calculations if I have reached the 40,000 threshold while in a year, for a few years while contributing to a private company? So going back to the same thing, it's slightly different query, but I will explain, what is the answer. If, for example, when first of all you're looking at your annual allowance potential charge, you do have to know how much was your growth or contributions in the last 3 years. In fact, whether you have got any carry forward amount from the last year or year before or the year before that, you need to know that you need to know whether there were some knock-on effect from the fourth last, fifth last, and sixth last years or not. For example, in last year, your pension pot grew by 55,000. So from last year, you don't have any carry forward amount. But the year before, you had an unutilized carried forward amount of 25,000. Out of the 25,000, last year you were over by 15. 55 means 15 over 40. So out of the 25, which is the second last year, standing in 2021, my last year is 1920 and 1819 is my second last year. So in the second last year, I had a carried forward of 25,000 pound. Last year, I was overpaid by 15. So I still have unutilized carry forward amount of 10,000 pound, 25 minus 15, 10,000 pound from second last year. So that's why it's so important that I need to go back 6 years to find out the knock-on effects, to find out the current year. So coming back to the question on this, so when I'm looking at a particular tax year, I need to know.
Stop it. I'm leaving.
I need to know. Don't worry, that's fine. We all have young kids. So I need to know my carry forward, unutilized carried forward amount from the years. Two, whether my annual allowance has been tapered or not. And this is more pertinent until 1920. Because 2021, lot of the senior clinicians will be out of it. Because as we all know, that in the current tax year, 2021, the threshold earning or the taxable earning limit is 200,000. So they wouldn't look into your annual allowance to be tapered or not until your taxable earning. Taxable earning means all earnings minus pension contributions or any minus any deductible allowances, right? Like your private pension contributions or any other, say, subscriptions or anything, right? Okay, so whatever is deductible according to the tax law. So that taxable earning, if it's until it hits 200,000, you're okay. If it hits 200,000, then you have to add certain other things on top of that, like your pension growth and other things, right? Then if it's more than 240,000, then you've got a problem. Your annual allowance may be tapered by 50% of the amount you're over and above 240,000. Otherwise not. So these are the three things you need to know. How much is the growth in this year plus any private pension contribution? Two is whether you've got any carry forward and unutilized allowances from the last 3 years. And three is whether you are impacted by the tapering or not. Once you know all these three things, you can find out that fine, where do you stand in the current tax year? And depending on what's your situation, then you can disclose it to HMRC if it makes sense. Number 11, contributions not being uploaded by capital. So these types of things, right, Akia, you have to personally follow up with them. You need to know the correct figures, otherwise you are unable to furnish it to HMRC. But the good thing about disclosure and filling in a form called SPE2, Sierra Papa Echo 2, which is basically scheme pay option. So you have to fill in. One is you have to file the return. So let me try finding out whether I can share. I somewhere, opened up. So yeah, so one is a fact sheet when you're trying to fill in the forms, and then the HMRC tax filing, tax return form. Under all you need to know, you have to put the details in 4IA, page number, sorry, AI4. You have to remember this is AI3. The next page is AI4, and there you have to fill in the pension savings tax charges. And there's one more form, scheme pay form, which is called SPE2, where you have to disclose that how much is payable through your annual allowance charge. Sorry. So these are the forms you need to know, or how to fill in. You don't have to know if you've got an accountant, right? And in that case, your accountant will be doing this. So unfortunately, if you are getting wrong figures, you still have to fill in the form if you think that you have gone above your stipulated standard allowance or tapered annual allowance, because HMRC and scheme pay allows you to amend it within the next 4 years. So if you fill in something now and later on you found out that the figures were not correct, as long as you have disclosed it, you can go back and amend. But if you haven't disclosed it, if you haven't filled in the form on the onset, unfortunately, your window for amending it later on is gone. You can't amend it because you never, on the first place, filled it. If there is no annual allowance liability as of now and not expect a liability in the future, do you still have to fill the form? No. Answer is no. If I ask the scheme to pay for my pension-related tax on the wrong advice of an accountant, can I pay it now? No. If the accountant is wrong, sorry, just now I told you in answer number 11 that if you haven't filled in the form on the first place, you can't amend. But having said that, in 1920, they gave you the opportunity to disclose all the last years, right? So no harm. Had I been in your place, I would have disclosed it anyway if I came to know about it later on and then request, because sometimes these are all case to case basis. HMRC may accept it because if you can establish that it was not your fault, but I can't guarantee. So those were the questions I got, and rest of the questions were repeats. So I didn't copy them over here, right? So I'm sure there are loads of more questions which are not answered in this session in those 13. Please feel free, because I can see already there are probably, last time I checked, it was more than 10 questions. Probably not now, more than that. So if you let Vivek collate it and send it across to me, and then I will try answering them personally. Now we're coming in. This is a broader segment.
Could I just interrupt, please? Sorry.
Of course you can. Yeah.
I do apologize. It's a valid point. When we are filling up the HMRC form,
Yeah.
I think the scheme based form and the HMRC form.
Yeah.
We have got two PTSRs. That is one for 1995, one from 2015.
Correct.
But the form SPE2 or whichever in the HMRC thing, it allows you to put only one. This is a point of confusion, because if you call it the HMRC, all they want is how they're going to collect money from the scheme pays, whether it's England or Scotland. I have no idea why HMRC and the scheme pays or these schemes have not talked to each other and put in another additional column for putting two separate things. Because ultimately, when the statement comes in, particularly for the Scottish statement, it clearly mentions from 1995 scheme, this much will be sacrificed from your particular pension pot, and they will pay HMRC that much amount. 2015 scheme, likewise. The only way I have found that we can get through this, and in the first instance, HMRC never even looked at it. There's a note section, and you can upload, if you're doing it online, you can upload your statements onto the note section and put in a note. Sometimes HMRC doesn't look into that. It's a particular problem. I think it's a problem with the system. Thank you.
So who was it? Very was it?
Raj Padmanabhan.
Sorry?
Raj Padmanabhan from Scotland.
Thank you very much, Raj Padmanabhan. Thanks a lot. Right, very valid point. I don't work for HMRC, but to be fair, let me just explain one particular thing, why probably they do it. HMRC is not interested in who pays it, right? Because your scheme may pay it, you may pay it personally. They only want to know that what is the liability. Because it may be through your personal pension, it may be through your NHS pension, even it may be through your NHS AVC pension. right? So all they know that as long as this person has disclosed that he is supposed to pay or she is supposed to pay £5,000 to HMRC, they are happy and they will see whether that amount has been paid or not. And then comes this SPE2 form, where I read somewhere in one of the fact sheets of SPE2, it says that you're not allowed to pick and choose that I will pay the whole lot from 95 scheme or I will pay the whole lot from 2015 scheme. It will be a mix and match depending on how much has arisen from each of them. And that's where that mandatory scheme pay and the voluntary scheme pay comes into. I'm not going into complications and I'm not fully knowledgeable also, right? All I'm saying that read the notes and try doing the best. And if not, if you're not certain, speak to your accountant, because tax thing is accountant, right? Or directly make a ring, call up SPP or NHS or the taxman, right? Which is HMRC, right? And then if some mistake has been done, just put your hands up and then tell them that, sorry, there was not enough guidance. I've done this. Can it be amended? And they will try their best, right? So sorry, it's not an answer, but it's just loud thinking. Coming to the next, do you need NHS? Do we need NHS pension? Can you not just come out of it? Right. Right. This is a question a lot of people ask. 1995, you can retire at 60. You got by default tax-free cash lump sum. They changed the goalpost. 2008, you only can retire 65, and there is no by default tax-free cash lump sum. If you want to get some tax-free cash lump sum, you'll have to forego in the ratio 12:1. If you need 12 quits of tax-free cash lump sum, your pension will be reduced by £1 and so on. And then came the latest 2015 scheme. And with the 2015 scheme also, they are struggling, and that's why they have increased the employer's contribution, and they may increase the other contributions also. And if they can't survive, nobody knows whether there may be further changes in the schemes or not, right? So you are valid in thinking, where are we progressing? And a lot of people are worried also that it only allows me to take the full benefit. The 2015 scheme only allows me to take the full benefit at age 67. And how long I'm going to live. So let me just paint a picture, right? These are all cons, not so good things about NHS, but then I will answer that, right? So I'm trying to establish your anxiety through my painting. So, and then they think, hang on, I got 1 million in my pot and I'm not taking benefit until I'm 67. So I still have 1 million in that NHS deemed pot. And then I get £40,000 pension. So it will take 20 years to break even, forget about the growth, to break even, to get that full 1 million out of NHS pot, right? Come to me. And 67 plus 20 is 87. So what is the validity? What is the possibility, feasibility that I may survive or my spouse may survive? Mind that spouse will get only 50%. So she will get only, or he will get only 20,000, not full 40,000 pension, right? So how long will it need to break even? That's the anxiety, that's the angriness, or that's the query, right? Vis-a-vis, let's look at it. First of all, you probably need some sort of guarantee that, yes, come what may, I will get this much of pension. So though there is no right or wrong answer, but you have to ask yourself, are you a very conservative person? Are you a very risk-averse person? Or are you willing to take a risk? If you are a risk-averse person, if you rather would go for certainty in life, fully knowing that certainty comes with a cost, nothing is free. Even that certainty comes with a cost. And the cost is you may end up not utilizing your full NHS pension. And what are the certainties? It's a guaranteed pension, because even if stock market crashes, even if something drastically changes in the economy and the world, you still get that £40,000 from age 67. Of course, you can draw from it earlier, as long as you're okay to get this is the, I hope you can see it. These are the actuarial reduction for the 2015 scheme, right? That means if you're taking it 7 years earlier, it will be reduced by 31%. So instead of 40,000 pound, you'll get 69% of £40,000, right? So just short of 28,000 per annum. So all is not lost. So you have to ask yourself, one is guaranteed, two is spousal pension, three, which is a lesser feature probably, that children will get, if no spouse is there, children will get 50% benefit until their age of 23, unless they have got any incapacity, because the definition of dependency is age 23. Then when you have started drawing from it, it goes up every year with inflation. So these are the features sometimes people are more attracted towards. So you'll have to ask yourself. There is no generic answer. How one would answer it without knowing that how much risk that person is willing to take, right? So if somebody says that it's bogus, it's bad. No, that's very false statement, right? So I will refrain from saying that. Having said that, if you think that you don't like this, right? In that case, let it build up a particular point of time. I mean, until a particular amount, say 30,000, 35,000, you're comfortable with, and then, or if you've got spare earnings, put that into private pensions. But that luxury may not be available for a lot of the senior clinicians because you're already exhausting your 40,000 limit and your lifetime allowance, right? So it's a very murky and muddy water. There is no straightforward answer. So you have to ask yourself, you have to bounce back your thoughts with your financial advisor, to your accountant, and then take an informed decision choice from that, right? But blanketly, there is absolutely no way of saying whether it's a good one or a bad one. Sorry, right? If my response didn't give you the required clarity. What happens to the pension when I die? Very good question. If I die, right, while I'm taking the pension, that means I am 60 plus or 67 plus. I have been starting to draw pension from the NHS and then suddenly I died. Then, if I'm single, no children, unfortunately, everything is stopped. If I'm single without any beneficiary, because there is a separate thing called death in service benefit and there is a separate thing called pension. You can fill in a nomination form for your death in service benefits to an unrelated person, your sister or something, but not your pension eligibility. To get the pension, it has to be spouse or children, dependent on you. So, if you're single, lost. If you are married and you still have your spouse living, unfortunately, when you passed away, then spouse gets 50% of your eligibility, right? So if you are getting 40,000 pounds, she will keep receiving 20,000 pounds as pension as long as she lives. And then similarly, children, if they're below 23, unfortunately, the member passed. Sorry, go on. Was somebody said something?
Shubho, you can continue. I think it's just a mic error from somewhere.
Okay, that's fine. Okay, sorry. So regarding this, that's the condition. That's what happens when somebody's drawing pension and unfortunately passed away. But if I just ask the question in a different way, what happens to my pension pot if I die before drawing the pension from it? Right? In that case, right, I get the tax-free cash lump sum, and depending on, right, you get. I mean, you have got, if you single, then unfortunately there's nothing else. But if you are married, then your spouse who is surviving after you still qualify for the pension. But to calculate the amount of pension, if you haven't attained your age 60, whatever your current pension pot size was, it will be based on that. So you'll have to fill in a form. NHS will come back to you saying that this was the eligibility for the surviving spouse, and you can still claim pension out of that. It's not totally lost. It's slightly different for private pension, but since the question doesn't ask for the private pension, I will store it for later part. How to read total reward statement? I think I answered this one in the previous one. When you look at your total reward statement, you're looking at your basically from critical point of view, you need to look at your pension amount from 1995 scheme or 2008 scheme, whichever scheme you're a member of, and your 2015 scheme. And then try finding out that how close you are to your lifetime allowance. Simplistically saying, there is a formula to calculate your lifetime allowance. SPPA guys are very lucky because your SPPA statement gives you the calculation for your lifetime allowance, not only for individually for the schemes, they also add them up and tell you that what percentage of your current lifetime allowance you have already used. Whereas in NHS statement, this England and Wales statement, they don't do the calculations for you. So it's your responsibility or your accountant responsibility. It's not difficult. Time 20 of your pension amount, projected pension amount, and add the tax-free cash. That's the deemed pot size of your 1995 scheme. Similarly, for 2015 scheme, your projected pension, time it by 20, there is no tax-free cash by default, and add them up. That's your total pot size, and compare that with the lifetime allowance. So in 1920, your latest pension statement is for 1920. The standard lifetime allowance was 1.055 million. And in 2021, the standard lifetime allowance is 1.0731 million, right? 1,073,100 pounds. Now, another thing you'll have to look into, right? That means this is your current status. And whether you hit your lifetime allowance, standard lifetime allowance within 31st of March 2016 or not. Sorry, I'm expanding the question. There's a reason, because some of you may have hit the standard lifetime allowance before 2016. For those senior clinicians, you have to fill in a form called Individual Protection 2016. That means you can protect your spot, right? So just do some Google search and other things on individual protection scheme 2016 scheme, and find out. There was another one, fixed protection, but you can't do fixed protection because one of the conditions of fixed protection is that the moment you opt for it, you have to stop contributing into your NHS pension, right? So your pension cannot grow. It can grow by CPI inflation, but not due to contribution. So you have to opt out and then fill in the form, fixed benefit form or fixed protection form. So only the individual protection form allows you to fill the form and also keep contributing into the scheme. So that's your lifetime allowance. So one is the total pot size. And of course, you need to, because HMRC sometimes may not be 100 in 100, but maybe 1 in 100, they sometimes do the calculations wrongly, right? So you need to think about that, because if there's a mistake and it's not amended, corrected automatically by them, then you end up suffering for it. And then you will only realize when probably down the line you have already retired. And to fix it then is a huge ask. So look at it. If something looks not right, please shout out. Similarly, I would say on the annual allowance statement also, if something doesn't look right, shout out.
Sorry, Shubhu, just two related questions very quickly.
Yes.
People have asked. Please mention lump sum to surviving spouse if death occurs before drawing pension.
Yeah. So it's 3 times of your pensionable earning, not taxable, pensionable earning. Now, if you pull out your March pay slip of a particular tax year, that will give you somewhere left hand side bottom, somewhere it will give your gross pensionable earning throughout the year and your gross taxable earning in the year. If you are in Scotland, your P60 also will give both the figures, your total gross earnings and your superannuation. So what is your net taxable earning, right? So you need to know your pensionable earning, and 3 times of your pensionable earning, latest pensionable earning, will be the death in service benefit to the surviving spouse. By default, you don't have to fill in. If you want your spouse to get it, right, then you don't have to fill in any form. HMRC, as long as HMRC knows that you are married. For example, when you started working, you were single and then married later on, the state was never updated, then you've got a duty to let them know. But otherwise, if they know that you're married, then by default your spouse is the beneficiary. But sometimes, especially from my financial advisor's point of view, some of the members don't want the wife to receive it because of the inheritance tax problems. They want children to get it, the next generation to get it, so that it doesn't enter their state. In that case, HMRC doesn't know that. Sorry, NHS or SPPA doesn't know that. So you have to fill in a different nomination form that my tax-free cash or death in service benefit should go to this person.
And
Anup?
thanks, Shubhu. Just Raj has asked one thing very quickly, I think related. Currently, there is no widower pension, only widow pension. So I just want to ask, is it true? And does nominating beneficiaries for death in service take it outside your personal estate?
It does if it's done through a asset preservation trust. Sorry, let me explain. For example, I'm a member, and if I died, so my wife gets everything. She hasn't died as yet, right? She will live for another 20 years, 5 years, 10 years, whatever it is, right? So it's her money now, and inheritance tax is payable at the point of the second spouse's death. It doesn't impact the estate at the point of first spouse's death. It only impacts at the point of second spouse's death. So once on the first spouse's death, the money is paid to the surviving spouse, and now it's part of the bigger estate. And then after 5 years, the surviving spouse also dies, which is the second part. Then the inheritance tax is calculated. So it has it has inflated your estate. So that's why you need to do something. You have to fill in a form, which is called asset preservation trust, right? And let that benefit go to you can't pass it on to your spouse through that asset preservation trust. It needs to go to somebody else, like your children or nephew, nieces, in case you don't want to pass it on to your children, right? Or if you don't have children. In that case, it never enters. It's like short-circuited. So it remains, because pension is a trust, be it NHS or private. So it is already sat outside your estate. But on death, that trust releases the money and enters the estate. So if you want to keep it in the separate trust and let it go to another trust without entering the estate, the only of doing it is by putting up asset preservation trust where you nominate your non-spousal beneficiary in that trust as the beneficiary on your death, so that the death in service benefit never enters the estate. It remains outside the estate and paid to your nominated beneficiaries like your children. Does it answer it?
Thanks, Shubho. Thanks.
Right. To carry on. So next one is early exit, later drawing, CPI increase. Yes, bang on. Because if you exit early, I've already shown you shared with you the actuarial reduction sheet. Similarly, there is for 1995 and 2008 scheme. So this is 60s, 1995. So for example, you're supposed to retire at 60, but some of the members, depending on when they started, are allowed to retire at 50. But usually we know that currently, if you are 55 by 31st of March 2028, then your minimum pension age is 55. Then you can start claiming from here. But if you start drawing from age 55, your 1995 scheme, there will be a 21% reduction in the pension and 15% reduction is the default lump sum. Similarly, you can look at the figures for 2008 and 2015. So going back, so that's the early exit. Now, early exit may not necessarily mean that you are drawing the pension also. You exited from it, that means opted out. A lot of you do it, especially in Scotland, because if you are hitting your annual allowance, you may contribute for 3 months and opt out for the rest 9 months, right? In that case, you are exiting, but you are not drawing. Then there is no impact, right? Only thing is that your growth in the pension pot during the tax year is lesser and controlled. Later drawings, if you have hit the age of 60 and you're still a member of 2015, or you haven't hit the age of 60, you're still contributing to 2015 scheme, then though your 1995 scheme is not directly your live membership in, but it still goes up, not because the number of years you were in 1995 scheme has gone up, because it's stopped. Because if you joined NHS 2002, 2015, 13 years, so you'll get 13 years equivalent of benefit. But the final salary definition keeps on changing. For example, in 2015, your final salary was, you just become a consultant, 82,000. But fast forward, you gradually, your consultant pay goes up. And then in 15 years time, say you retired in 2030. So you're, instead of 82, now you're on 110, right? So obviously you'll be benefited for that final salary. If that last 3 years best salary was 110, so your 1995 scheme also, growth also will be reflected due to that growth in your pensionable salary. So in the formula, if you can remember how we calculate the pension in 1995 scheme, it's 1/80th times the number of years you have stayed in the scheme. These two things become constant the moment you are in 2015, if you have joined 2015 scheme. So you were, in this particular example, you joined 2002 NHS and you joined in 1995 scheme, and you started contributing into 2015, post 2015. So you have only 18 years in 1995 scheme. So in this particular example, 1/80th times 18, sorry, 2015 minus 2002, 13, 1/80th times 13 times final salary. So though first and second element doesn't change, do not change, but your final salary changes from 82,000 in 2015 to 110 or whatever it is when you actually retire. So that grows your pension pot. But if you have left NHS altogether, you are now 62 and you're not contributing in a 95 scheme, you not contributing into 2015 scheme. You have left and you're only doing private practice. In that case, and you are not drawing also because you thought, hang on, I'm earning enough and I don't want to start drawing my pension because that will even increase my tax bill. So I will keep working for another couple of years and then start drawing. In those 2 years, your pension grows in line with the CPI. Right? I think that's the answer you have been looking for, whoever asked this question. 21, when is it good thing to come out of the scheme? There is no right or wrong because every question is very complicated. Right. I'm assuming that you have got some idea that what happens when you come out of the scheme. That means if you have come out of both the schemes, because if you are coming out because of the lifetime allowance has been hit, then it only grows by CPI. But mind that if it's a problem of lifetime allowance and you are only 55 and you want to draw your pension from age 58, just now I showed you that if you are age 58 and you are trying to draw from your 1995 scheme, that means you have to forego 10% of your benefit. Now, the moment you are foregoing 10% of your benefit, in the earlier example, if your deemed pension amount or the projected pension amount is £40,000 per annum, if you forego 10% means £4,000 reduced, that means it's now 34,000. The moment you use, and your tax-free cash lump sum, 3 times of 40,000 was 120, but you are taking a hit of 6% on that because of retiring at 58. If you use these two figures, instead of 40, 36,000, and instead of 120,000, 6% less than that, your lifetime allowance pot also has shrunk. Probably you realize. So that gets rid of your lifetime allowance charge. So sometimes remaining in the scheme, right, let it go beyond lifetime allowance pot, limit threshold, is beneficial because you are planning to draw from it at an earlier age. So that even after paying the lifetime allowance charge, you have come below 1 million or 1.073 million. So now you don't have to pay the lifetime allowance. Sometimes it acts in your benefit. So again, no blanket answer. Bounce back your ideas to your financial advisor, people like me, and then make some informed decision. If you decide to retire at 60, then how do you calculate your 2015 scheme pension? So if you totally retire from 60, just now I told you, so I'm not spending much time on it. You'll take 7 years equivalent of hit because there is no default tax-free cash. It's only hit on the pension, which is 31%. So if your deemed 2015 scheme pension was 40,000, only through 2015 scheme, right? Making the example easier to understand. So just ignore the 1995 scheme or 2008 scheme, depending on which scheme you are in. If your projected pension through the 2015 scheme was £40,000, and if you're trying to draw from it at age 60, then you'll take 31% hit. 1/3 of that £40,000, which is roughly around, say, £12,000, £13,000, will be gone. So we will have a gross pension of at age 60 from the same scheme of 27,000, if it makes sense. But if you decide to retire at 60, stop contributing. But since you are not willing to take that hit of early actuarial reduction through the early retirement, in that case, you wait until age 67 and then only draw from it. But in the meantime, between age 60 and 67, you should have some other sources of earnings. I don't know. Right on. So I'm restarting now. Thank you very much for coming back. On number 23, what is earned revaluation? It's very simple. It's basically 1.4% plus the inflation rate on that, 1.5% plus the inflation rate on that particular year, right? So if different years have got different inflation rates, and when I say inflation rate for the year, I remind you that it's basically the inflation rate published by Bank of England for the month of September in the prior calendar year, the prior calendar year. So it's if you add them up, 1.5 per 1 plus 1.4%, it will be 2.9% for that, and so on and so forth. This is the revaluation rate for 2015 scheme. How can you predict whether you will cross LTA? You can extrapolate. Now, if you see that, if you know the formulas for calculating the pension, example is if you are in 2015 scheme, then it's 154th times 1 year. If you are trying to calculate it for that particular year, 1 year times the pensionable earning for that tax year. So if it's say 108, it's for just simplicity's sake, for this to keep the mathematics simple. If you had pensionable earning of 108 in that year, so 1 by 54 times 108 means 108 divided by 54, so 20,000. Sorry, 2,000 pound. What did I say? So 1 by 54 times 108,000. So yeah, 2,000 pounds. So the growth in your, of course, that 108 has to be the career average for 2015 scheme. So you have 108 average. In that case, your growth in the 2015 scheme, don't read much in this example because this is just some figures to facilitate some understanding. So your pension growth in 2015 pot will be 2,000 pound in that tax year. If your pension through that 2015 scheme is 2,000 pound in that year, then your lifetime allowance will be 2,000 pounds. Sorry, 2,000 pounds times 20, which is 40,000 pound. Right? So if you think that more or less, if you add your growth in the 1995 scheme and 2015 scheme is around 40,000, again for simplicity's sake, then if you got 200,000 left, say you are hypothetically your limit is 1.1 and you are already 700,000, so you got 400,000 headroom in your allowance, right? In that case, you think that fine, how many more years will it be before I hit that 1.1 million? It may be another, say, 40,000. 200,000 divided by 40 is 5 years, 4-5 years. So you calculate that every year, and probably you can extrapolate that probably it will take another 2-3 years to hit, or 4-5 years to hit my lifetime allowance. But mind that lifetime allowance doesn't remain same. It creeps up every year by the inflation rate. So it was 1 million in 16-17, 17-18, and then it was 1.033 million, it was 1.055 million, and this year it is 1,073,100 pounds, right? So you can sort of, it's not exact science, but you can, if you can project your lifetime allowance now, and if you can more or less estimate that in the next year or a year after how much the pension pot growth will be, then you can find out that how many more years left before you have lost your headroom. Number 25, can I get my NHS pension before age 66? The answer is yes. If you are prepared, I'm assuming that 66, that person who asked this is got his 2015 scheme pension age as 66, right? So in that case, the answer is yes. And as long as you are prepared to take the actuarial reduction hit, and I have gone back to that sheet, ARER, right? Actual reduction estimation rate for 2015 scheme. Every year you forego so much if you're trying to take it early. So for example, if your pensionable age is 66 and, sorry, let me go to 2015 scheme, and your this thing you are trying to take it at 65, so you are hit by 1 year's worth of actuarial reduction. But if your pensionable age is 66 and if you're trying to take it at 64, then 3 years earlier, so 16%, and so on and so forth, right? If it makes sense. Then will I lose out on the benefits? Of course you will, right? So you will lose out on the benefits through the actuarial reduction. Then if I leave NHS after working for 20 years, but before I am 55 years of age, no, if you leave the pension scheme, but if you don't start drawing before the age 55, which is the minimum pensionable age for the people who are not going to be 55 before 31st of March 2028, then no problem. You don't have to be 55. You worked only for 20 years. Say hypothetically you started at 25, you're 45, you have left NHS and went into private sector. the pension is still there, the pot is still there, and it's only growing by CPI. And then the option would be that don't do anything if you don't join back NHS, and then when you are that particular scheme's normal pension age, that means I'm assuming that you are talking about 2015 scheme. When you hit 66, you can take the full benefit, whatever that frozen benefit was, right? Deferred benefit was through 2015 scheme without any reduction. But if you decide to take it for age 55, then you'll have to look at what is the 10 years worth of, 11 years worth of actual reduction, which is massive. It only allows you to take 12 years before, because if 67 is your state pension age, and if you start drawing from it at age 55, you're taking it 12 years early, 2015 scheme, then your pension pot will be reduced by, or the pension benefit will be reduced by 45%. If you're willing to do that, the answer is yes. Number 26. I was in NHS pension 1995 for 12 years. Fair enough. 1995, mind that. So 1/80th times 12 times your final salary. And if your salary was maximum when you left, then that particular salary, and then have been a locum for 6 years and done pension contributions to private providers. Now I'm back in the NHS and plans to stay for 15 years. Mind that if you have joined back after 2015, then you won't be able to join back in 95. It will be 2015 scheme. So you got a frozen pot of 95 through 12 years of worth of benefit in it. And now we have rejoined NHS 15 scheme as a starter. And then you spent 15 years till the age of 60. That means you're 45 when you joined until the age of 60. So 15 years worth of pension in 15 scheme. Can I get a 1995 scheme draw? Yes, when you hit 60, if you're not taking from 2015 scheme, of course you can draw from 1995 scheme. It allows you to do so and still be a member of 2015 scheme. But if you decided to draw both from the pots, so you'll get your 1995 scheme, which is 12 years worth, and then 15 scheme, depending on how many years you have spent in it. If it's 15 years, then 15 years worth. Of course, that pension was supposed to come to you through the 2015 scheme at your age 67. If I assume that your state pension age or the normal pension age through your 2015 scheme is 67, you have to take a hit of 7 years worth of actuarial reduction through the 2015 scheme. But the answer is yes, you can start drawing. There may be reduction in benefits, but yes. What should I ask from private and NHS pension providers to see what my tax liability will be at the point of receiving pensions? Right. NHS won't be able to tell you. It all depends on, if we are talking about income tax, then it will depend on your deemed pension size. That means whether you're a 20% taxpayer post-retirement. But if you're talking about lifetime allowance, because by the sound of it, it's lifetime allowance oriented, because it's 1.1 million, will I cross the, right? They won't be able to project because you have to keep knowing that if you're in SPPA, brilliant, you will know straight away. Because in the SPPA statement, they will tell you that in the tax year finished on 31st of March, which has just ended, how much was your pension pot size? And if you have left in between a tax, the next tax year, then of course you'll have to ask for a final statement, and that will show if you are a part of Scotland, then you will Scottish public pension. Then you will get a statement which will show your lifetime allowance pot. But if you are NHS, the question is for NHS, it won't tell you. Then you'll have to do the calculation yourself and find out where you stand vis-a-vis the lifetime allowance, standard lifetime allowance at that point in time. Mind that if you are doing it in 2020-21, the pot size is different, 1.0731 million. Whereas if you're looking at the same thing next tax year or year after, just find out the latest pension pot lifetime allowance size is. Next question is, NHS pension the best pension? A myth, considering I've already answered it, right? Concerning annual allowance, because annual allowance is going to bite you even through private pension, right? Only difference is that NHS is growth oriented, pension growth, pension input amount, whereas this private pension is contribution oriented, right? How much you have put into. But annual allowance is applicable for private pensions also. Retiring at 67, yes, that's one particular point which is beneficial, for people who want to retire early, because minimum pension age, I'm reiterating because I've already told this enough number of times, if you are going to be age 55 by 31st of March 2028, then your minimum pension age in UK is going to be 55. Otherwise, it will be 10 years below your state pension age. It will be 10 years below your state pension age. So if your state pension is 66, then 56. If it's 67, 57, 68, 58. If, God forbid, if it becomes 70 some point in time for new members, it will be 60. Average lifespan 75. I won't comment on that because I've got something to share which I will do when I come to the relevant segment. If in 15 years I have contributed to his pension from 2012, though I withdrew from it earlier. Withdrew means I didn't withdraw the pension properly, but I stopped contributing. I'm 45 now, and is it worth to contribute till 67? Very good question, right? It will be circumstances oriented. How is your health? How's your marital? What is your marital status? If you're single, then it's even lesser reason. Why? Because the attractions are less. Because after you, everything finishes, right? Your life expectancy. So those are the factors, and of course your attitude to risk, your attitude towards life. Are you a very conservative person? You're a high risk person. So those are the things, and whether you've got other provisions or not. If you've got plenty of other provisions to play around, then of course your dependency on your NHS pension is less. But if you don't have very many options, like a few buy-to-let properties, another private pension, or other ISAs and other things, then probably you need to ask yourself that, if this is my sole pension and this is the pot I'm heavily going to be dependent, I've got, wife, no disrespect, but if I take or I'm a lady and I've got a husband who doesn't work, or he's a homemaker, or he's a private sector and never contributed into pension, then how important this NHS pension is for me or my family, and that will answer whether you want to restart contributing into 15 scheme or not. If we require at 60 with pension age 67 in 2015 scheme and don't take the pension from 2015 scheme, I will be able to draw on 95 scheme, correct? But what will be the calculation for 2015? If you have stopped deferred, means you have stopped contributing into it. That means it will only go up whatever the amount was when you left the scheme, and then it will keep going up in line with the inflation rate, which is currently consumer price index. Some of my pension questions for next session, I can draw down the 95 pot, right? The only difference is one, it says deferred, the other one, it says contribution, and that's why I have kept both. Otherwise, they sound very similar. When I turn 60, correct? The 95 you can draw without any actuarial reduction. What will be the effect of this on further pension contributions in 2015 scheme? So you're not deferring, you're not coming out of it, you're still contributing. If you're not coming out of 1995 scheme, right? You are contributing into 2015 scheme. You can't opt out of 95 because you have to opt out of NHS pension. If you opt out of NHS pension, you're not contributing into any scheme. But if you want to opt out from one, sorry, that's not possible. So if you remain in NHS, still working with them and still contributing your NHS pension contributions, then by default, your 1995 scheme will grow in line with your final salary. If your final salary goes up, if it doesn't go up, if it remains similar. For example, some of the GPs, they are very cautious not to let their pensionable income go up. In that case, probably it will remain pretty much same. But if you're contributing right into that, then it's not CPI. It's always your final salary or the care. Because if you're a GP, it was never final salary. It was always career average revalued earnings. So it will still grow depending on whether the average is going up or not, right? Revalued average is going up or not. Next one says, will like addition? Brilliant. This is the only question which was not covered in my,
Excuse me, please. Could I
Yeah,
continue?
yeah.
It's Raj again. Sorry.
Hi, Raj. Hi.
I think that there's a slight confusion. I think I attended one of the BMA seminars. I understood from the BMA seminar that once you crystallize your 95 contribution to age 60, you cannot contribute further to the 2015 scheme. You just become a deferred member if you continue working. And that, as you said, grows until you decide to crystallize your 2015 section. But I don't think you can further contribute this. The BMA Pensions Committee is hardly, I mean, they're working hard on trying to get this changed because of the potential effects on workforce planning and workforce shortages at a later stage. I'm happy to be corrected on this, and I'm not, an authority on this, but this is what I gathered from that particular seminar. We'll know better when the remedy period comes in, when the discussion goes on between the government and the BMA Pensions Committee on what happens after this.
Raj, thank you. Thanks for your heads up. Right. Basically, let me revisit the question. Basically, if you are in 1995 scheme, this is sharing my understanding, right? I'm not refuting anything. So if you are in that scheme and you started you use the word crystallization, that means you started drawing your 1995 scheme, right? But in this one, if you retire 60 with pension 67 and don't take the pension from 2015, so if I read it as you are not taking the pension from 95 also. If you take the pension from 1995, then of course that career average or final salary growth doesn't come into the picture because you have started drawing from it. So the 95 scheme only grows by the CPI. If you have started drawing from 1995 scheme, you have to come out of the pension scheme for 28 days. There's a stipulated period, right? And then you can join back your 2015 scheme. That's my understanding, right? There are some available there. That means you can, and you can still contribute into 2015 scheme. But anyway, I will come back on this if that's okay with you. Right. So,
Thank you.
no problem, Raj. That's fine. Right. So contributions, I've already mentioned that. Additional years contribution. First of all, no new members can join additional years anymore. Added years, if you mean added years, right? Because there's an additional pension. There are two different things. Additional pension is a different thing. Added years are different things. Since this nomenclature says additional years, right? I'm reading it as added years. If somebody was a member of 1995 scheme, they could have joined added years. That means basically you are buying years. So for example, you calculated that I joined 1995 scheme at the age of 30 and I will retire at 60. So I will have 30 years. So why not increase it by another 10 years so that I get equivalent benefit of 40 years working? So they will do some calculations and they'll say, fine, every year you'll have to contribute slightly more so that when you are 60, you have already contributed the whole amount and you'll get 10 more years. And you'll get paid on 40 equivalent years. That means instead of calculating it as 30 upon 80, they will calculate 40 upon 80 in this particular example times your final salary. So you're getting 10 years worth of additional pension on 188 accrual rate. So you have to contribute additional amount, but they stopped that. So the moment 2008 scheme came into play, nobody could join in new. Currently, of course, nobody can go back in time and rejoin. So if somebody was already started contributing into added years of 1995 scheme and never came out of it, right? Then they are still making contributions into it. And a related question on top of that is, what happens if you are hitting too much on your annual allowance every year and you end up paying annual allowance charges, or you are very close to lifetime allowance and you are finding that, no point putting in additional years. I'm not saying right or wrong. I'm saying that you have decided not to contribute anymore into additional years or added years, sorry. In that case, whenever you come out, they will do a pro rata calculation. That fine, you were on the onset, you agreed, contractually agreed that you will contribute so many years, 30 years to get the full 10 years worth of benefit. But you are coming out after 20 years. Hypothetically, you came out, you're 50 now, so you're coming out of it 10 years earlier than 60. Then they will do a pro rata calculation that no, you won't get the full 10 years worth of benefit. You have only contributed so much, so you'll get, say, 6.5, 7. I'm not giving an example, right? This is just figures to paint the picture that they will do the pro rata calculation and tell you that this is the pro rata number of years you will get on top of your normal 30 years or whatever it is. Right? So that's added years. But if you meant additional pension is another way of contributing more into on top of your NHS pension. So, for example, one of the questions I think read in the chat box is that I joined quite late. So, how can I top up my pensions? So, of course, one of the questions answers is through NHS or outside NHS. Outside NHS is pension, personal pensions or SIPs. Through NHS is you've got two options. One is additional pension. There is an online calculator in your website, and you can go and ask that how much pension will I get. Sorry, if I want £5,000 on top of my NHS main scheme, final salary schemes, how much will I have to contribute if I want to get another £5,000 from age? You'll have to put in the age 60, 62, 65, 67, right? So they will calculate and tell you if you want to put in lump sum, this is the amount you'll have to pay. And if you want to pay regular, this is the amount you'll have to pay, or a mix and match. The pros and cons very quickly is that it's guaranteed. That means they later on can't move the goalpost. That means whatever they are telling you on that calculator at the onset, they are committed to that. And secondly, when you stop contributing into it and you started drawing from it, it will go up in line with CPI every year. Of course, there are bolted on facilities on the onset. If you want your spouse to get 50% benefit, then of course the premium will go up. For everything, there is a cost. And since it's guaranteed, that means they can't move the goalpost later on. They can't reduce it depending on stock market performance otherwise, right? Then, so there is a cost. So some of the applicants may find out that it's slightly costlier or whatever it is, right? But these are the good features, guaranteed and CPI linked. But it's not contributed, or the contribution is not matched by the employer. And it is not part of your final salary or career average scheme. It's not part of main scheme. It's just topping up, but you have to contribute it separately, and there is no matching employer's contribution. And there's the second option through NHS is AVC, which is like a private pension. Only thing NHS has done is that negotiated some low annual management costs with the providers. Currently 2 or 3 providers are there. From the top of my head, the Standard Life is there, and I think Prudential is also there, and there's a third provider, I think. So, but it is DIY. You have to manage it on your own. Then moving on, I exited NHS in 2011, and I went abroad and was a member from 2000. Oh, only 1 year. I exited NHS 2011. I went abroad and was a member from 2000. So only 11 years, sorry. Which scheme would I be in? Of course, 1995. If you join 2000, which is before 2008, that means you will be 1995 scheme. And then contributing while abroad, yes, you can't make any contributions while abroad because you have to have pensionable earning in UK to be able to contribute. You have to have pensionable earning in UK, or some called relevant earnings in UK, taxable earnings in UK, because you can't contribute if you haven't paid tax, or if you aren't taxable or tax resident in UK. So you have to look into your status there, I think. Right. So the way it works, you left, hypothetically, this is totally plucked from air, you left UK in the month of September. So you have contributed for first 5 months, let's call it beginning of September. First 5 months you have earned, your pensionable earning was 50,000, hypothetically, 50,000, right? So you can contribute up to £50,000 into your pension in that tax year. So you'll have to find out how much your growth will be in NHS pension through those 5 months equivalent of being in the membership in that scheme or multiple schemes. And then if you've got any headroom between that, because you can't contribute. So let's revisit the limit, how much you can contribute into pensions in UK. You can only contribute £40,000, the standard annual allowance or your tapered annual allowance, if any, plus your unutilized carried forward annual allowances from the last 3 years. So that's one set of figure, 40,000 or tapered, plus carried forward last 3 years. So let's call it X. On the other hand, it's 100% of your pensionable earning, Y, whichever is lower. So you can't contribute more than that in a particular tax year into any UK pensions, right? So if you are abroad, you'll have to look into a particular tax year, how much your pensionable earning or relevant earnings were in those tax years. Does pension grow after we start drawing in? Yes. After you started drawing in, it only goes up by inflation, which is currently Consumer Price Index. Can I give my opinion on EFRBS? So EFRBS is basically employer finance retirement benefit scheme. It's a non-approved scheme. It doesn't, so some of the businesses opt for EFRBS. So it's basically non-approved schemes. So it doesn't qualify for the similar tax advantages as other UK regulated approved pension schemes do. That means it may not qualify for your highest marginal tax relief and stuff like that, right? So it all depends on that particular scheme. I would be tempted to request you that to do some more digging and start asking a few more questions that what that particular scheme. So prima facie, they are unapproved schemes in UK, and you may not, you may contribute, but you may not be able to claim the tax relief on it. What should I do if I hit LTA limit? I've already tried answering it when I am 61. Stopping contribution is one of the options, definitely, but it will be more, more towards looking into areas like when you are turning 61, and am I talking about, are you talking about 2015 scheme? Are you talking about 1995 scheme? If you're talking about 1995 scheme, no problems. 2015 scheme, then you have to think that, hang on, that 2015 scheme benefit is the amount without any deduction if I only draw from age 67 or 66, depending on, or 68, depending what my state pension age is. But if I'm trying to draw from it at an earlier age, I need to let it grow beyond my lifetime allowance, so that even after paying the actuarial reduction, I'm okay, I'm just below my lifetime allowance, right? And so these are the questions you need to ask, one needs to ask. And one is actuarial reduction, definitely, right? And then there is another thing which can impact your lifetime allowance pot. If there had been number of years you opted for scheme pay, if there had been quite a few number of years, 1, 2, 3, 4, 5 years, where you filled in the forms, the relevant forms, SPE2, and opted for scheme pay, the scheme pays only 2019-20 in England and Wales. The government has agreed that the trust will pick up the bill. But rest of the years, they haven't been such generous. So actually, it is picked up from your pot. So that shrinks your pot. So one is, if you have to go through any actuarial reduction, the second thing which can reduce or shrink your pot is through opting for scheme pay. So you need to look into those things, that after these two things, if impacted, whether how the new reduced, shrunk pot size is it still above LTA? If not, your query is answered already. If yes, then you need to ask yourself that what probably the best option is coming out of it, or whatever it is. But as I mentioned, there is no blanket answer. You need to look into your personal circumstances. What happens to my pension if I die after retirement? We have already answered it, right? That means your spouse gets, or your dependent gets 50% of the eligibility amount, as long as he or she lives. Can we continue to contribute to 2015 scheme even if we start drawing from 1995 scheme? We have tried answering it. There is a stipulated period you have to come out of it, the scheme. There's a cooling off period, and then you can go back into that, right? In terms of maximizing the NHS pension benefits, minimizing the tax implications, maximizing pension benefits, minimizing tax implications, how many sessions should I? Right, this is a very complicated question. And for that, what I've done, I have, I'm sharing that this is a consultants. This is basically the pay, NHS pay updated in August, I think, right? So if you are in this contract, 2003 onwards, consultant contract, then in the first year for doing, these are all average 10 sessions, right? Basic salary 82, and then depending on what is your experience, how many years you have been consultant, every year your salary goes up. And then you get your increments every 5 years. So fifth year, and then next, so you remain in 92, and then after 5 years, it's 98, and then, so it's not simple. So if you are a very senior and experienced consultant, have been consultant for 19 years, then this is your standard wage, assuming that you don't do anything, because this is your code. So if you're not doing anything else, or if you're not getting any award or other things, right, then this is your basic. And your pension growth reflects your basic change in your basic salaries and stuff like that, or your annual allowance. Right? So there is no straightforward answer. You need to find out that what is your, even with your 10 PA or 8 PA, what is your current full-time equivalent pay is, and how much it has gone up by. How much? So 80,000 is very good when somebody becomes consultant, but mind that with the same sessions, regular hours, there will be increments. Just now I showed you, right? So you have to factor those in, that between 2 years, beginning of the tax year and end of the tax year, how much the growth has been, and that growth will be reflected in the growth in your pension pot. And depending on that, you may or may not have to pay any annual allowance charges, right? If it makes sense. So your tax implications basically depends on the growth. I'm reading it as your annual allowance charge. Otherwise, it's straight and simple. Whatever contributions you're making, that's being deducted from your occupational, your gross pay. And when you get to your net pay, you have already saved tax on your gross pay. Bless you. Number 41, if moving abroad temporarily, how long before you are forced to? I have already answered that, right? It's only the tax year and it's the pensionable or relevant earnings. Depending on that, you can still. You can remain in the NHS pension. That's not a problem, right? But you can't contribute into it, right? So you can come back, or you don't have to come back, right? You're still in abroad, but when you hit your respective normal pension age, if it's a 95 scheme, otherwise 65, if it's a 2008 scheme, or 67, 68, 66, if you're a 2015 scheme member, you can start drawing. Or if you're prepared to let it reduce through actual reduction, you can even draw later on. So, but you can't, unfortunately, can't contribute unless you're a tax resident in UK. That's all related to generic and lifetime allowance. Then salary sacrifice. There are something. This was very important. Interesting thing. I have personally gone into that BMA this thing Excel spreadsheet and did some examples for me, for some of my clients, and so on and so forth. Right? Yeah. So there are a few highlight points I'd like to share. You try your own. Right. This is a good thing, especially if you're thinking in terms of, if I want to lease a car through the NHS pool car facility, and that will reduce my pensionable earning, right, as well as taxable earning, and I'll save on that. And for lease of that car, I'm saving some money, right? So it costs less for me. And then what is the impact when I finish the lease, and if I don't go and replace my car or upgrade my car and continue with another lease, what happens? Suddenly there's a change in my pensionable earnings, and that's giving growth to my pensionable earnings. Pension pot will grow in that particular tax year, and how am I? It is not forward, because there will be growth in your pension pot. So actually, you'll see benefit that your pension has grown in that tax year, because as I mentioned, that your pension growth or the pension calculation is based on your pensionable salary at the beginning of the tax year and end of the tax year, and which scheme you're in, and the inflation rate, and so on and so forth. Right? So your pension will grow, and that may give rise to some annual allowance charge. So you need to play around, need to find out. It's not always bad. You may see that that the impact is more than offset by the savings in the tax. But there may be situations. Yes, absolutely, I agree. There may be situations where the savings you're making through that NHS lease is more than offset by the annual allowance charge you may have to pay. So you have to put your own figures in and have a look in that impact. But it's not blanket. Nothing is blanket. Sorry. So QROPs, qualified regulated overseas pension schemes. In gist, if you are say looking to move abroad, sometimes, I'm giving an example, I'm assuming that not all of you may be from India, but some of you are, or majority of you may be from India. So if you're thinking that, fine, I will retire and move back to India, that's my future plan, like as of now. So you may think that, fine, fair enough, I will transfer my NHS pen into QROPs. I'm not going into the fact that whether I agree, approve, or disapprove it, right? Because I'll have a very long conversation, right? I personally think that you need to look into the risks and the pros and cons before jumping into any conclusions at all, because I'm very old school sort of advisor. But anyway, if I agree that you're looking into that option, qualified regulated overseas pension schemes, you had initially requested for pension transfer. This is a personal thing. I won't be able to answer it. That whether, even though I submitted within the time limit, they did not process it, saying they did not have enough time, and hence the transfer cannot be done. I have all the evidence to suggest yes, worth asking, because if you appeal, it may be turned around. So if you don't ask, you don't get. As simple as that, right? So you have to ask. But obviously, I'm in no position to comment that whether it will be a successful appeal or not, right? Is there a way of transferring my pension back to India under old scheme through legal means? I can't answer it. Right? So you have to try and find out whether the authorities agree or not. If you've got a good case, they may. Who knows? But if they find enough reasons that they can't do it, then unfortunately they may not be able to. So I can't answer it. But all I can say, year to year, HMRC approves or withdraws approval of the qualified regulated overseas pension schemes. If you go back to their website, you may see 15 this year, you may see 13 next year. And one of the pension schemes have been removed because they only allow the NHS pension scheme to be moved into a because they approve of it, right? So year to year they update the list, and it has been shrinking. I know personally that there has, in the past, I'm talking about 7, 8, 10 years before, there were 40, 50 QROPs, and now currently it's shrunk to less than 20, right? And so you have to be very careful. If you go back next year, the one you initially fancied may not be in that list. I'm not saying it may not, it won't be. I'm saying it may or may not be, right? So you have to be very careful that which scheme you're transferring it into, whether it's still in the list or not. Some of us transferred. And one more thing, related to this, though it's not asking this question, I don't know how many of you have heard of, I'm guessing that all of you have heard of, benefit crystallization event. It is basically the other name for the time when your lifetime allowance is calculated. So when you're transferring your, when you retire, that's one BCE. There are 11 or 12 types of BCEs, different events. One of them, when you are simply retiring, that point in time, if you're, started drawing from your NHS schemes, they will calculate how much is your deemed pension pot sizes, and if you're over the stipulated lifetime allowance, then you may have to pay some lifetime allowance charge. Similarly, say for example, somebody didn't draw from his or her private pension and reached the age of 75. By default, age 75 is another benefit crystallization event, right? So they will, by default, though you are not taking benefit from it, but they will assume that as if at age 75 you are to draw from your 2000 private pension, and they will find out what is your total pension pot size is, and you may or may not have to pay. Similarly, when you are transferring from your NHS scheme from UK to a Europe in Malta, it is based, right? Then event of is reckoned as a benefit crystallization event, and they will calculate your deemed pension pot size at the time of transfer. And if you are below LTA, fair enough. But if you are over LTA, they will ask you to pay the lifetime allowance charge. Is the pension transferred via QROPs to India treated as private pension? Yes, it is. They may have their own pension age, like 55, or they may give you 25% tax-free cash and so on and so forth, right? But they are not treated as NHS pensions anymore, if you mean that. If moving to Australia and entering a local pension fund that is approved for transfer of the NHS pension, can you subsequently return from the foreign pension fund back into the NHS pension fund on returning to the UK? The answer is no. NHS, as I mentioned, you have already crystallized because it's taken as deemed benefit crystallization event. So, NHS, if you read the NHS pension schemes, it can accept some of the transfers from other similar, pension schemes, which are final salary de facto. NHS AVC, which is a deemed money purchase or defined contribution scheme, can accept transferring depending on the fine prints of that provider from a private pension. Sorry,
Sorry, please, if others mute, please.
sorry. Yeah. So unless you want to ask me something, or you can type it in the chat.
Across the
Yeah, thank you. So if you are coming back from Australia to UK, in that case, you can't transfer your superannuation scheme in Australia into NHS scheme because you have already deemed as you have crystallized your NHS pension and you have calculated your lifetime allowance and so forth. But having said that, some of the private pensions in UK, depending on their own scheme definitions and approvals, you can be able to transfer some of the superannuity from other countries into UK pensions, right? So you have to look into the fine prints. But by default, NHS final salary, if you're trying to transfer a private pension from Australia or other Australian superannuation schemes, they by default don't allow. Change in retirement age, right? This is very interesting, right? Now, I'm not trying to prove or disprove, but after I read this question, I went into some of the studies already made. So this is Scottish study. I will give you an example. Sorry, one from Scotland, one from England and Wales. This particular one says, if you can read the screen, which I'm trying to share, this is the results. So we're not interested in methods. These are the results. So life expectancy of white Scottish is 74.7, whereas mixed background 79.3, Pakistanis with a background from Pakistan is 84.6, and I read somewhere from Indian background somewhere in 79 or something like that, right? So what I'm trying to establish is that it's not blanket. And similarly, I did pull out a similar study for England and Wales. So this is mortality. Mortality means the potential death. About 14% of the population of England is non-white. Life expectancy data is not available by ethnic group because no such studies were carried. Ethnicity is not recorded at death registration. Using alternative methods of analyzing ethnic differences, some evidences, so it's not conclusive, don't get me wrong. Most Black, Asian and minority ethnic groups have lower mortality, contrary to the usual idea, other than compared to the white population. But it was totally reversed through COVID. So COVID made us think that probably BMEs have got lower, higher mortality. No, some of the studies, it's not conclusive. So first of all, before we go for that, we have to go and find out whether there was a proper ethnic diversity related study were done or not, and if there's any conclusive proof that BMEs may die before our white British counterparts, right? So otherwise we can't. Next one is MacLeod judgment. A lot of you are already reading this. So in nutshell, what happens? One of the civil servants protested in the court of law that younger people who are in final salary schemes are being discriminated against in comparison to the older member schemes. Let me paint a picture. If you are in 1995 scheme, and if you assume that 1995 scheme is a better scheme because of the two main reasons, it allows you to retire at 60, and by default, it gives you tax-free cash lump sum. And compared to 2015 scheme. 2015 scheme just based on these two, because the accrual growth rate, which is 180th for 95 scheme, is inferior to 2015 scheme accrual rate, which is 154. So part of the disadvantage they have tried offsetting by increasing the rate in 2015 scheme. But if you ignore that, if you just consider that I wanted to retire at 60, when I joined NHS, I was under the impression that I will be allowed to go at 60, but now you are moving the goalpost, so you've got every right to protest. So I'm painting the picture again, coming back to the picture. So I was under that, and then suddenly I found out that as on 31st of March 2012, I am having more than 13 years before I'm hitting 60. So by default, they didn't even ask me. By default, they made me go into 2015 scheme effective from 1st of April 2015. I was never consulted, right? Okay, so, but the people who were having between 10 and 13 years before they hit 60, as on 31st of March 2012, because that's when the study was made, They were asked to join 2015 scheme in a tapered manner between 2015 and 2022. And there was a third group who had less than 10 years left between their age then, as on 31st of March 2012, and age 60. And they were told by default that they don't have to join 2015 scheme. So there were three groups of people. Now, when this civil servant went to the court, they said that why? Because they also were affected by similar changes in their final salary scheme. They said that the people who were older than us, first of all, who were having less than 10 years left before they hit age 60, when compared to the other groups, they were not asked to join the 2015 scheme. So they were very happy. They were allowed to retire with the 1995 scheme benefit at age 60. Whereas we being younger, as if we are being penalized because of our younger age. And the good thing is that the court accepted that yes, it is a case of age discrimination against age. But then they said that fine, how to rectify it? They said that people are going to be affected between 2015 and 2022 because the tapered people will keep on joining until 2022. So they said that all the scheme members will be given, especially the younger ones, but all the scheme members, because 2015 scheme, they are not affected at all. So all the scheme members who were affected by this will be given two options. Either they want to remain in 2015 scheme because they were by default asked to join 2015 scheme, or they want to move back to 1995 scheme, even from 2015 when they were moved. And they have to, so there is no problem. They will be given the two options. But now they are studying, the consultation paper is going that when they are going to do that calculation and give the options to you, is it at the onset or at the back ended when you hit 60? And most of the members through BMS and others, they have opted for at the time of retirement. There's a simple reason. If imagine you are given two sets of figures now, that this is how your pension pot will look like if you remain in 2015 scheme, 2015 onwards, or if you're deemed to be a member of 1995 scheme between 2015 and 2022, this is how much your pension pots are going to look like. Mind that we are giving those figures at age 60, when you will hit at age 60. And you haven't hit your age 60 now. So those are based on extrapolated estimated figures in future. So they may not exact correct figures. They are estimated figures. On the other hand, if the same option is given to you when you hit 60, they already know the inflation rates during until you are age 60, because they are doing the calculation when you have hit 60 or when you are within 3 months of hitting age 60. They know your pensionable earnings throughout the year. So these calculations, when they give you the two options, these calculations are based on actual figures. So on one occasion, they may ask you to select based on anticipated figures, which may or may not be correct when you hit 60. And on the other one, if they ask you the same question, giving the two options, when you hit 60, they are going to be based on actual figures. So, no rocket science. All of them asked for, can we have the option given to us and when we hit age 60? So they are going to make that as a law, and that will come to you, and then nobody has to apply for it. Automatically, the options are going to be posted to you when you hit 60 and something. But anyway, the announcement will come up, right? They're yet to announce. The questions are, if it happens so, whether it is going to impact the tax charge and the annual allowance charge, right, or not. So they are basically, part of the same, different questions, but based on the same event of the MacLeod judgment. So yes, it may or may not, because if your career average after 2015 is going to be less than your final salary, because 1995 scheme, that it's calculated on final salary. That means the definition of final salary is best in the last 3 years of your working life. And career averages, they will take the revalued earnings and then add them up and divide it by the number of years. So depending on if your pension pot is grown more under 1995 scheme, then obviously there may be some impact on the annual allowance charges. So, but anyway, this is generic question. So ERRBO, very quickly, it's basically early retirement reduction benefit, buyout, early retirement reduction buyout. Simplistically saying that if somebody is trying to retire at age 65, who is a member of scheme 2015, they will end up 2 years worth of penalty or actuarial reduction, which is 11%. So imagine you are this member and your state pension age or normal pension age is 67 and you want to retire 65. ERRBO doesn't give you any other option. It only gives you an option to retire at age 65 or 66. So if you're a scheme member whose 2015 scheme normal pension age is 66, then you can buy out 1 year's worth of reduction, actuarial reduction, 6%. If you are your NPA is 67, then you can buy out 2 years. So, or in future, if somebody finds out it's 68, then 3 years worth. But it doesn't allow you to buy the benefit or retiring earlier than 65. So the minimum age is 65. And whatever the actuarial reduction amount is, basically, you are agreeing to a contract that, hang on, you don't have to deduct it when I retire, when I hit age 65. Rather, tell me how much I'll have to contribute every year from now onwards so that you get that 11% from me. And when I actually hit the age 65, you are not going to reduce my pension age anymore because I've already contributed to that actuarial reduction amount. The beauty is that in some of the trusts, you can negotiate with your employer and they may allow the employer to pay into that. Your employer can, if they agree, pay all or part of the required additional contributions on your behalf. So that's the beauty. One is that some people may think that instead of them reducing from my final salary, final pension pot, rather I will contribute it now so that I get the full benefit then. Or provided you are willing to retire at or draw down your 2015 scheme from age 65. If that be so, then in that case, it is a good benefit if you deem fit. Or alternatively, if your employer picks up the bill, even better reason, right? So that's all I wanted to say around this particular option. Then comes, this is basically a lot of you asked me that not me personally. The member asked me that you are not a big fan of 2015 scheme. So what are the other options and so on and so forth? Yes, private pensions are options because in one of these questions, because I'm aware of the time also, so I will club these up and it will hopefully make sense to you. Because the crux is more or less same. First of all, any contribution into a private pension qualifies for or is taken into consideration for the calculation of annual allowance as well as for the calculation of lifetime allowance. So only the difference is that it's not the growth, it's the actual contribution into your annual allowance, private pension, which is added on top of your growth in the NHS scheme. And the total amount is compared against your tapered or otherwise standard annual allowance or carried forward annual allowance, and then they calculate how much your annual allowance charge is. So yes, pretty much you have to be mindful of the fact that contributing to private pension also may impact your annual allowance. Similarly, when you retire, if your total pension pot size through NHS is 1 million and your total pension pot size through private pension is 200,000, so your deemed total pension pot size is 1.2 million. And if your standard annual allowance is hypothetically in this example is 1.1 million, then when you retire, then you are over and above the lifetime allowance by 100,000 and you'll have to pay the lifetime allowance charge. The lifetime allowance charge is on the marginal amount, the excess amount only. In this particular example is 100,000, right? And you may have to pay 55% tax charge on lifetime allowance if you want to draw that 100,000 as cash, or if you want to keep it in your pension and draw income from it, then you have to pay 25% reduction as well as normal income tax, right? Now, private pensions also qualify for your tax relief, but private pensions don't get your employer's contribution. So if you come out of NHS, then you'll have to think that you're losing your employer's contribution into your NHS scheme. Good, bad comparison, I'm not going about that. I'm just stating the facts that any private pension, unless it is occupational pension, AVC and others, even AVC don't qualify for, or additional pension don't qualify for your employer's contribution. Only if somebody works for the private sector and the private sector company offers a private pension, or not a private pension, occupational pension, but which is a defined contribution or money, which is not a final salary pension, and occupational pension contribution is matched by your employer, right? In that case only you may get some matching, but NHS doctors don't get matching on private pensions. Third thing is that, yes, these are benefits that you can start drawing from it. Minimum pension age. You can pass it on to your children. Wife. You can even encash private pensions, unlike NHS, because NHS, after you, your spouse gets 50%, and unfortunately, after your spouse is not there anymore, you lose the pension pot if it's NHS pots. But private pensions, after you can pass it on to your wife or children. And even if your children draw only the income from it, keep the capital, they can pass it on to your grandchildren. It's called generational succession. So yes, it can be on pen and paper, it can be transferred as long as it's not totally exhausted. There is something left in the pot. It can transfer as many times as you want, right? From one nominated beneficiary to another. And one last thing about private pension is that you will have to bear in mind that it is when you're investing can fluctuate with the stock market, right? So these are the things about. So you have to look after it. You have to have a, say, for example, financial advisor who is giving you the best advice and so on and so forth, right? But it's not a bad thing. But personally speaking, I will only encourage one to consider private pensions once they have already contributed into their NHS pension and still they have got some cash flow and additional money which they can put into private pensions. And especially when you are looking for retiring earlier than your state pension age, which is 67. With this, I will finish today's session. I'm mindful of the fact that some of you are hungry probably because it's past 2 o'clock now. And I clubbed up the last question, but otherwise I didn't compromise with the earlier questions, which are more pertinent in my mind. But feel free. There are loads of questions in the chat box I can see. And feel free to contact me directly. I have typed my personal contact details in the chat box, as well as you can come and contact me in my website, which is very simple to remember. Shubho Kundu Wealth WM, which is short form for wealth management.co.uk. Shubho Kundu WM.co.uk. Thank you very much. Thanks for your patience.